Let's connect with Rob Subramaniam, Chief Economist, Asia ex-Japan. He represents Nomura. He joins us live from Hong Kong. Rob, good morning. Thank you for joining us. Rob, I guess US Fed last night pretty much has, they pretty much have admitted to the obvious, and they have indicated also the obvious.
So I think at the US, the Fed meeting, as we expected at Nomura, there was no real new news. It was a pretty boring affair given all the announcements at the December meeting. So I think, you know, they've said they've conditioned the quantitative easing, I guess you call it number 4 now, QE4, on when the unemployment rate comes down to, you know, at least 6.5%. So we're nowhere near that yet. So, you know, our view is that this $85 billion worth of US Fed buying of treasuries and MBS is going to continue at least into around Q3. And the risk is it continues even further out.
So, Rob, what's the best case scenario for equities? With QE3 intact, do you think it is a fair case that perhaps the bull run's here to stay and we will see a repeat of what we've seen in January already for US equities?
So I think, you know, one of the things in favor of equities right now is in the fixed income markets, the compression of spreads, high grade, even high yield has happened so substantially that there is a move looking for other asset classes, including equities, possibly commodities. You know, the risks I would see for this rotation towards equities, the risks are that, you know, for equities you do need real growth, and so if the fiscal situation in the US actually, as we start to hit important dates in March, and then the debt ceiling again in May, if they go poorly, you know, the bad GDP number we just got overnight, you know, the risk is we don't get as much recovery as everyone expects in the US. That's one risk. I'd say the other risk for equities is this continued very, very loose monetary policy ultimately leads to inflation, and that would be bad for profits in equities. So they're the two risks, I would say. But generally, you know, I think at the moment this rotation is looking like it is happening.
Rob, but do you think globally some degree of complacency also has kicked in, because global volatility as we speak is sitting at a historic low?
Well, it is funny when you look at the world now and you look at it, you know, 6 months ago, what has really changed? I mean, Europe is still in a severe recession, actually worse than economists generally thought for Spain, with the data out recently. You know, I think China has problems with regards to the debt build-up, and Asia generally there's risks of, I think, overheating, and the US is only just starting to embark on fiscal tightening. So I think I have some sympathy with that view that, you know, maybe we're a bit too complacent and we have to be careful. Certainly the markets are rallying on very easy money right now. But, you know, some of the more structural issues in some of these major economies have yet to be fully dealt with.
Rob, so major equity markets have rallied about 20% plus without a major pullback. Is it safe to assume that a correction is round the corner, not only for you know, US equities, but for emerging market equities as well? Because if inflation is the key risk, then inflation certainly will get you know, stroked further and further, because copper, you know, aluminum and crude, major commodities which drive inflation, are sitting at a multi-month high.
Yes, they have moved up, and that's in line with the stronger demand. But, you know, I share your concern, and you know, at Nomura, the view for at least emerging Asia is that inflation is going to start to rise in the second half of the year. But, you know, in China, it could be over 3% by once we get February print. So we are seeing in the weekly data that food prices in China are starting to rise. There's been big wage hikes in countries like Indonesia and Thailand. And growth is bumping up against potential. Even in India, where growth is very, very weak, inflation is remaining, stubbornly high, around 7%. And if, as you say, commodity prices go up, there hasn't been much progress in reducing fuel subsidies, food subsidies. We could quickly start to see that translate into another rise in inflation and worsening fiscal positions in India, potentially Indonesia and some other Southeast Asian countries.
So in that regard, how would you rate Indian equities at this point, Rob?
I think we need to be careful with Indian equities. The view we have is that fundamentals in India are, let's face it, they look like they're the worst in Asia right now. Large fiscal deficit, highest public debt, largest current account deficit, among the highest inflation. These are pretty bad fundamentals. The government now is starting to move, making progress with reforms, but second half of the year, as we get closer to the elections, can the government continue the momentum on reforms? That's a question mark, and if it doesn't, it could prove very difficult to finance the current account deficit, which is heading towards 5% of GDP this fiscal year. So India, I think, has challenges. You talked about equities. I would say the biggest risk, though, is actually the rupee reversing again and starting to slide, potentially to a record weak level this year. We expect it to hit around 60 by the third quarter against the dollar.
60, Rob? That certainly is the most bearish number on the street.
Well, there you go.
Rob, but what about the policy measures? Do you think the policy measures which the government has initiated, incrementally things will improve for India?
So I think the government has made some important steps with regards to FDI in various areas. I think there has been a little bit of progress on the fuel subsidy. I think the budget end of February, I think is going to show more positive steps. But the key thing I think for India to realize is it's reached the GDP per capita threshold. Incomes per persons have reached that level, getting up towards $2,000 per person, where demand is taking off for cars, for durable goods, for traveling. And you need urgently, much more urgently than 3-4 years ago, to create the supply. That means new investment. And that doesn't come overnight. So India needs to persistently push through reforms, create the climate for more private investment, foreign investment. And that can't just be done for a quarter or two. It needs to be persistent. And I think that's going to be the challenge. It's okay, to do it this quarter and maybe next quarter, but can India continue that into the third and fourth quarters of this year and early 2014? That's where we're a bit more skeptical.